August 15th, 1971, Sunday evening. 9:02 p.m. Eastern, a machinist named Robert Kern sits in his living room in Akron, Ohio, watching the tail end of Bonanza. He's 34, two kids asleep upstairs. His wife is folding laundry. The screen flickers, and suddenly the show cuts out. President Nixon appears. I have directed Secretary Connally to suspend temporarily the convertibility of the dollar into gold. Robert doesn't move. His wife looks up. What does that mean? He doesn't answer because he doesn't know. But something in Nixon's tone, calm, rehearsed, final, makes his stomach tighten. He's been saving $127 a month in a passbook account at First National. The plan is simple: 10 more years, then a down payment on a house with a garage, a future you can see. On screen, Nixon's face, grainy broadcast footage. The president keeps talking, something about speculators, something about protecting American workers. Robert hears the words, but they don't connect. What he feels is this: the rules just changed and nobody asked him. By Monday morning, gold prices will spike. By the end of the year, inflation will be accelerating. By 1980, Robert's savings, still sitting in that same account, will have lost more than half their purchasing power. He didn't know it yet, but on that Sunday night, the ground underneath 50 years of American middle-class wealth quietly collapsed. To understand what actually happened, we need to rewind. Chapter 1, The Visible Story, the gold standard and the promise for most of the 20th century. The U.S. dollar wasn't just paper, it was a promise backed by metal. Under the Bretton Woods system, established in 1944, every dollar was theoretically convertible into gold at a fixed rate, $35 per ounce. Foreign governments could exchange their dollars for physical gold held at Fort Knox. This wasn't symbolic, it was a constraint. The U.S. government couldn't print unlimited money because every new dollar had to be backed, at least in theory, by gold reserves. B-roll, Fort Knox exterior, stacks of gold bars. For American workers, this system meant something simple: your money held its value. Between 1950 and 1965, inflation averaged just 1.3% per year. A dollar saved in 1950 was still worth 82 cents in 1965. You could plan, you could save. The future was legible. But by the late 1960s, cracks were forming. The Vietnam War was expensive. President Johnson's Great Society programs, Medicare, Medicaid, expanded welfare, were expensive. The U.S. was running large budget deficits, and to finance them, the government was printing more dollars, a lot more. On screen, Federal Deficit Chart, 1965 to 1971, foreign governments noticed. By 1971, there were roughly $60 billion in foreign-held dollars, but only $12 billion in U.S. gold reserves. The math was simple and terrifying. If even a fraction of those foreign dollars came back for redemption, the U.S. would run out of gold. France, under Charles de Gaulle, began converting dollars into gold aggressively. Other countries followed. The gold was leaving Fort Knox in cargo planes. On screen, graph showing declining U.S. gold reserves, 1968 to 1971. In public, Treasury Secretary John Connally projected confidence. The dollar is sound. Our commitment to convertibility is firm. In private, the Nixon administration knew the system was breaking. On August 13, 1971, a Friday, Nixon gathered his top advisors at Camp David. No press, no leaks. By Sunday night, the decision was made. The United States would no longer honor its promise. The gold window was closed, permanently. Nixon called it temporary. It wasn't, and here's the part that doesn't fit the optimistic narrative. Closing the gold window didn't solve the crisis. It just moved the consequences onto someone else, onto people like Robert Kern. Chapter 2, The Hidden Mechanism, How Fiat Money Actually Works. Let's be precise about what changed on August 15, 1971. Before that date, the dollar was anchored. It had a fixed relationship to something scarce and physical. After that date, the dollar became fiat currency. Money by decree, its value was no longer tied to gold or to anything else. It was worth what the government said it was worth and what people believed it was worth. This is not inherently bad, but it removes a critical constraint. On screen, simple diagram, gold standard versus fiat system. Here's the mechanism in 3 steps. Step 1, The government can now create money without limit. Under the gold standard, printing more dollars meant you needed more gold. Under fiat, printing more dollars just means printing more dollars. The Federal Reserve can expand the money supply by buying government bonds, lowering interest rates, or directly injecting liquidity into the banking system. There is no external anchor. The only limit is political will and fear of inflation. Step 2. Inflation becomes a hidden tax. When the money supply grows faster than the economy's productive capacity, prices rise. This is inflation, and inflation is a transfer of wealth from savers to debtors, from workers to asset owners, from the future to the present. Imagine Robert Kern's $127 monthly savings as a pile of claim tickets. Each ticket says, "This entitles you to 1 unit of future purchasing power." And in 1971, he has 1,524 tickets, but the government keeps printing more tickets and handing them out. By 1980, his 1,524 tickets are still there, but now there are millions more in circulation. His share of the economy's output has quietly shrunk. He didn't spend the money. He didn't lose it. It was taken from him silently through dilution. Step 3. The system rewards debt and punishes saving. Under fiat money, borrowers win and savers lose. If you take out a mortgage in 1971 and inflation runs at 7% per year, you're paying back the bank in dollars that are worth less every year. Your debt shrinks in real terms. But if you're saving cash in a bank account earning 3% interest while inflation runs at 7%, you're losing 4% per year in purchasing power. You're being taxed for doing the responsible thing. On screen, real return on savings 1971 to 1981 minus 3.2% per year. This wasn't an accident, it was a policy choice. The U.S. government, facing massive debts from war and social programs, effectively decided to inflate its way out, and the people who paid for it were the ones who couldn't protect themselves: wage earners, retirees, small savers, people like Robert Kern. This design works until trust in the currency itself begins to crack. Chapter 3. The breaking point, the inflation of the 1970s. Let's walk through what happened next. 1972, inflation ticks up to 3.3%, uncomfortable but manageable. The stock market rallies. Nixon wins re-election in a landslide. The economy feels strong. 1973, the Yom Kippur War. OPEC declares an oil embargo. Oil prices quadruple. Suddenly, inflation jumps to 6.2%. Gas lines form at stations across the country. The term stagflation enters the vocabulary. Rising prices combined with stagnant growth. B-roll, 1970s, gas station lines, cars waiting. 1974, inflation hits 11%. Nixon resigns. Gerald Ford takes office and launches a public campaign called Whip Inflation Now, complete with red and white buttons. It's a joke. Inflation doesn't care about buttons. 1975 to 1978. Inflation oscillates between 5% and 9%. The Federal Reserve, led by Arthur Burns, is paralyzed. Raising interest rates would trigger a recession. Keeping rates low fuels more inflation. Burns chooses the path of least resistance. He keeps rates low. Inflation accelerates. On screen, federal funds rate versus inflation rate 1971 to 1980. By 1979, inflation reaches 11.3%. Paul Volcker is appointed Fed chair. He makes a decision that Burns wouldn't. He raises interest rates to nearly 20%. The economy crashes into a brutal recession. Unemployment spikes above 10%, but inflation finally breaks. On screen, unemployment rate 1980 to 1982. Here's the human cost. Robert Kern, the machinist from Akron, is now 42. His savings account, which had $15,240 in 1971, now has $22,100. On paper, it looks like growth, but adjusted for inflation, that $22,100 is worth $9,800 in 1971 dollars. He lost more than a third of his purchasing power by doing nothing wrong. His wages went up, but not fast enough. His grocery bill tripled. His mortgage payment stayed the same, which helped, But he never bought that house with the garage. The down payment kept moving further away. And here's the kicker. He was one of the lucky ones. He kept his job. He didn't have a pension that got wiped out. He didn't retire in 1975 on a fixed income and watch his standard of living collapse. Millions of Americans did. The 1970s weren't just an economic inconvenience. They were a generational wealth transfer from the middle class to the government, from savers to debtors, from the future to the present. And it all started on August 15th, 1971, when Nixon closed the gold window and told the country it was temporary. By the time Volcker finally stabilized the currency, an entire decade of middle-class wealth had evaporated. Chapter 4. The system fights back. The new rules and the new risks. Paul Volcker's shock therapy worked. By 1983, inflation was back below 4%. The dollar stabilized. The crisis was over. But the system didn't go back to gold. It went forward into something new, a pure fiat regime, managed by central bankers with unprecedented power and no external constraints. Here's what changed. 1. The Federal Reserve became the anchor. Without gold, the only thing backing the dollar was the credibility of the Federal Reserve. If people believed the Fed would control inflation, the dollar held value. If they didn't, it collapsed. This gave the Fed enormous power, but also made the entire system dependent on trust in a small group of unelected technocrats. On screen, photo of Federal Reserve Building, Washington, D.C. In 1979, Volcker testified before Congress, "We have no choice but to deal with inflation. The alternative is the destruction of the currency itself." He was right, but notice what he didn't say. Who pays the cost of that fight? The answer, workers, small businesses, anyone with debt they couldn't service at 18% interest rates. 2. The government gained a new tool and a new temptation. Fiat money gave the government the ability to respond to crises by printing money. In 2008, the Fed created trillions of dollars to bail out the financial system. In 2020, it did the same to fight the pandemic recession. These interventions prevented collapse, but they also created a moral hazard, the knowledge that the government will always print money to prevent disaster. This encourages risk-taking, it rewards leverage, it punishes prudence. On screen, Federal Reserve balance sheet 1971 versus 2023. In 1971, the Fed's balance sheet was $80 billion. In 2023, it's over $8 trillion. That's a 100 times increase. The money supply has exploded, and every time it does, the same mechanism kicks in, silent dilution of purchasing power. 3. The winners and losers became structural. After 1971, the economy split into two tracks. If you owned assets, stocks, real estate, businesses, you did well. Asset prices inflated along with the money supply. The S&P 500 returned an average of 10% per year. Real estate in major cities became generational wealth, and if you relied on wages and savings, you fell behind. Real wage growth stagnated. Savings accounts paid negative real returns for decades. Pensions collapsed or were replaced with 401s, Ks that shifted risk onto workers. On screen, wealth inequality chart 1971 to 2023. The Gini coefficient, a measure of inequality, was 0.39 in 1970. By 2020, it was 0.49. The gap widened, and the primary driver was monetary policy. The system survived. But it survived by transferring risk and cost onto the people least able to bear it. For someone like Robert Kern, now in his 80s, living on Social Security and whatever he managed to save, the ground under his feet is thinner than it was in 1971. The safety net is there, but it's stretched tight. One more crisis, one more round of money printing, and it might snap. Final verdict, what this really means for you. Let's be clear about what happened. August 15th, 1971 was not a temporary measure. It was a permanent regime change. The U.S. dollar went from being a claim on gold to being a claim on trust. That trust has held so far, but it's not guaranteed. Every time the government prints trillions of dollars, it tests the limits of that trust. 2. Inflation is not a natural disaster, it's a policy choice. When the government runs deficits and the Fed prints money to finance them, inflation is the result. It's a hidden tax, and it falls hardest on the people who can't protect themselves: wage earners, retirees, small savers. 3. The system is designed to protect institutions, not individuals. In every crisis since 1971 to 1980, 2008, 2020, the government's first move has been to stabilize banks, markets, and large corporations. Individual savers and workers absorb the cost through inflation, unemployment, or both. 4. The real risk is not the last crisis, it's the next one. The Fed's balance sheet is 100 times larger than it was in 1971. Government debt is over $34 trillion. The tools that saved the system in 2008 and 2020 are still in place, and they'll be used again. Each time, the money supply expands. Each time, your purchasing power quietly erodes. On screen, U.S. national debt clock ticking upward. Robert Kern didn't lose his savings in a bank run or a stock market crash. He lost them slowly and visibly over a decade because the rules changed and nobody told him. The gold window closed in 1971. The inflation window opened, and it never shut.